Well, it's 2021 and things are looking up. And I mean literally up. The stock market, earnings, interest rates. In fact, a lot of economic indicators have been rising since the start of the year. So is that good news for your retirement plan? Well, it depends. You guessed it, it's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. You've probably heard me describe investing for income as a strategy that works regardless of market conditions. But it can sometimes work even better because of market conditions. You see, all the recent market mania gives us a perfect opportunity to explain just how and why that can be true, which is exactly what we're going to be covering on today's show. Specifically, we're going to be discussing the unstoppable stock market, the battle between bonds and rising interest rates, and the impact of it all on income investors, and what new challenges and opportunities might just be lying ahead. And helping me out as usual is income specialist and best-selling author Jeff Small. But we're also going to be hearing from our good friend, options trader John Najarian, as well as income specialists Michael Stewart and Matthew Johnson. And as always, we'll answer some of your retirement questions. But first, let's start by talking about Wall Street. You know, it was just a little bit over a year ago in March that the stock market dropped almost 40% in response to these lockdowns due to the pandemic. And those were scary times, and they remain scary times for most of last year. Infection rates and deaths soared. Unemployment and economic shrinkage actually hit record levels. The only certainty was uncertainty. So Congress and the Fed acted quickly with historic amounts of federal aid. And that's probably one reason the stock market was able to rebound so incredibly fast. In fact, by July, both the S&P 500 and the NASDAQ had already surpassed their pre-pandemic peaks. By the end of the year, all three major market indices hit new record highs, and they've continued hitting new peaks ever since. Now, while these relief measures did have a lot to do with it, they really weren't the only thing driving the rebound. While many businesses were devastated by COVID-19, others actually benefited from the pandemic. Things like home shopping websites, food delivery services, even software companies like Zoom, and the list goes on. In fact, one silver lining in the dark cloud of COVID-19 is that it showed exactly how resilient our economy can be here in the United States. It put the spotlight on new businesses and new industries that were able to fill vital roles and to meet important needs. And if you think about it, that's great. But is it enough to explain the stock market's quick recovery? And since then, its continued strength, being that we're just a year past that drop? Well, obviously, we've come a long way since then. People are getting vaccinated, the economy is continuing to recover, and corporate earnings for the first quarter were even stronger than expected. So the question becomes, are we out of the woods? Does the stock market make perfect sense again? We'll be talking more about that coming up in just a moment. Before I talk to Jeff, let me take a moment to answer one of your questions. Anna from Ohio asks, is age 45 too young to start investing for income? Well, obviously, Anna, the answer depends upon your personal situation. But in general terms, the answer is probably no. Why? Because you don't have to give up growth or capital appreciation just to make that transition from a growth to an income focus. You could stay in the market, you could focus more on higher dividend paying stocks, get that income that you want that maybe you're going to need in the future at some point, but also not lock yourself out of the growth game. And Anna, that's a great question. We're also going to see what our next guest, John Najarian, has to say about that. And send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. Now, let's talk with Jeff Small. Good to see you, Jeff.
Hey, Dave. It's great to be here again today, and even with all of our esteemed guests. I'm looking forward to today's topics.
Yeah, and I bet you're particularly excited for us to introduce our first guest, John Najarian. John is an options trader and co-founder of MarketRebellion.com. John's also the co-author of the book, Follow the Smart Money. John, it's great to have you back here on The Income Generation.
Dave, thank you. Jeff, great to be with you both.
Hey, great to see you again, John. Want to keep the dialogue open here on what's happening with the markets right now and for the rest of 2021. It seems like we are in the massive MMT mode, more money today. That's part of what's fueling this rally. When do we see the money supply start to contract or the Fed start to taper, which will ultimately affect the markets?
That's, of course, the trillion-dollar question or several trillion-dollar question, Jeff. And instead of modern monetary theory, I like your definition of MMT more. But I think the Fed is going to have to start addressing this before the end of the year with a tapering, but not with tightening. I don't think that tightening happens for quite a while. And depending on what happens with the tax bill, Jeff, that'll have a little, believe it or not, that helps the Fed because if, and I'm hoping that they don't increase taxes as dramatically as they've said. I know Joe Manchin's against it, the senator from West Virginia. He's about, moving corporate taxes up a little to like 25, not to 28 or 30 like the administration wanted, and or that millionaires tax on capital gains. I think any of those things do moderate growth, even though we're going to get a spike in the short term for demand because of all the money that's been given out. So my answer to you, Jeff, is that we're going to probably see that tapering in the fourth quarter of this year, but no tightening because I think that'll be taken care of by what happens with or without the tax increases.
So, John, it sounds like you're in the camp of inflation being more transitory right now and not really permanent and long term. Am I hearing you correctly?
You are, sir. I think that's well said, Dave. I think how long lasting this inflation will be is going to be, basically how long does the government spigot stay wide open? I was just on a flight out to California and the plane was packed, not with business travelers, as you guys have both been reporting. It's mainly leisure that are getting on these planes. And I got to believe a lot of those folks were flying with stimulus dollars. They're going to Vegas, they're going to California and Florida. Great. But when that spigot gets turned off, it'll go back to normal. And I think that's that transient or, that temporary move up in inflation that you just addressed.
Yeah, and when supply chains get put back together properly in some of the areas where they're still fractured, that should help us out a lot too. We're going to be talking more with John Najarian right after the break. And later in the show, we'll take a closer look at what's happened this year in the bond market and what it could mean for you. You're watching The Income Generation, and we'll be right back.
Women are an economic powerhouse. We earn, control, and inherit more wealth than ever before. Our lives are truly a balancing act. It's not easy to juggle a career, a marriage, caregiving, and other life transitions. Yet we always rise to meet the challenge. Take charge of your retirement planning today so you can leave a legacy for your family tomorrow. Download our free Women and Wealth Guide to Retirement Planning. Find strategies to help grow, manage, and protect your assets. Visit womenandretirementnow.com.
Hey, welcome back to The Income Generation. I'm here with David Scranton and our special friend and repeat guest, John Najarian. John, great to have you back. Thank you for the dialogue.
Thank you, Jeff.
So, John, listen, we find ourselves in a position now where history always seems to repeat itself. But the biggest lesson of history is people don't seem to learn from it. We've seen this script in this movie before as we have record levels of debt. When does this become an issue? Does it ever become an issue? Does the debt just keep expanding and it's something we have to learn to accept?
Well, unfortunately, yes, is the answer. We're going to have to accept it. I don't see us just dismissing it. I think when the interest rates do start moving up, which we covered already, when that starts happening, then it becomes more incumbent on the government to either rein in some of the spending or increase taxes, which they love to do anyway. They love to do both of those two things because you get reelected, giving away money, and you are appealing to one side of the Democratic Party when you increase taxes. Obviously, I don't think you'll get a single Republican vote on that increasing taxes part, but sooner or later, yeah, the bill does come due and you got to pay the piper. And that's something that we all worry about. The debt has increased so dramatically since 2008, and it's just on a collision course with bad news if we have significantly higher rates. If the rates moderate, and if we get up to 2 for the 10-year and maybe even 2.5 next year, that's okay. But if we blow through 2 this year and are on our way to 3 or 4, which is where we were before the crisis, that's a really bad thing because that debt load is enormous and it gets heavier with higher interest rates.
Oh, that is such a good point, John. I mean, if rates go up with the debt load that it's at, it's going to be really hard to service. We're going to have problems. However, do you see rates being increased by the Fed or just going up organically because of the consumer demand and the economic expansion? Tell us how you feel about that.
I think it goes up at first because of the latter, that consumer demand, not because of the Fed, because of actual supply and demand, just as the three of us always talk about. Those are things that move the market. If you have more demand and less supply, you're going to move rates up. And I think that will happen. But then I think the rest of the world will respond to it as they've started to anyway, I guess, Jeff, because you've seen a lot of euro dollar investments, a lot of yen, of course, investments convert over into our bonds. Why? Because they're paying a yield that is significantly higher than what they can get over in those countries. And if they've got negative rates over there and they're able to come over here to ours and get nearly 150 to $2 or to 2%, which is where the 10% that 10-year is moving towards that 2% target, that's where I think you get the money flow that kind of holds the bonds back from otherwise going significantly higher, because the more bonds they buy, the rate moves down. So I think that's a moderating mechanism.
1 or 2% is always better than nothing, right? It's that simple. I've got to ask you though, when you were with us last time in January, you said, okay, buy the dips, but don't get sucked in necessarily to a 2% dip. Wait to something closer to a 10% dip, and you thought that would be a better buying opportunity sometime later in the year. Are you still thinking that way?
Yeah, I am. And you've heard analysts like Tony Dwyer over at Canaccord and others make that kind of statement. Everybody's kind of looking for what is going to kick us into the next corrective phase. We've had a couple very short corrections this year. I think we'll get one. We seem to get it every year of about 10 to 15%. Will I be surprised if that happens? No. I guess one of the outliers could be that the banks, which have been such an outperformer this year, if they softened up, that could be one of the catalysts. But it certainly doesn't seem like tech is going to be that softening mechanism, because those Microsoft earnings were great. We're going to be getting these Apple earnings, and I suspect that they're also going to be pretty darn good. So I'm thinking that the banks could be that soft spot, Dave.
Yeah, for tech to be the soft spot, we'd have to have a real spike in interest rates, but we certainly don't want that, like we discussed. So John, thanks so much for being back with us today on the Income Generation.
Thank you. Take care, guys.
And Jeff, stick around. We're to catch up with you a little bit later in the show. Now today, as you know, we're discussing the market mania that we've seen so far this year and how it impacts you if you're trying to invest for income. In fact, we've talked about mostly the resilient stock market. But now let's take a closer look at some of the mania happening lately in the bond market. So, as you probably know, short-term interest rates are actually set by the Federal Reserve. Long-term interest rates are determined by market forces, and this includes, of course, activity in the bond market. A simple way to look at this is that when interest rates rise, it's generally seen as a sign that bond buyers are actually optimistic. When interest rates fall or stay flat, it's read as a sign of economic pessimism. However, that's not the whole story. From 2000 to 2007, long-term interest rates, as measured by the yield on the 10-year government bond, hovered between 4 and 5%. But since then, it's only risen above 3% a couple of times. So what happened? Well, as we've already discussed, What happened was the financial crisis, or more accurately, the Fed's response to it. The Federal Reserve, in response to the financial crisis, launched unprecedented levels of quantitative easing, which basically involved buying up trillions and trillions of dollars of U.S. government bonds. And ultimately, this works to artificially suppress long-term interest rates. And the Fed supposedly began tapering off quantitative easing in 2014, but started again in 2019. Here's the reality. The Fed has been working in a whole bunch of different ways to artificially suppress long-term rates, almost on a non-stop basis since 2008. Then when COVID-19 hit last year, they announced open-ended quantitative easing. So this, when you combine it with all the economic pessimism at the start of the pandemic, pushed the yield on our very own 10-year government bond below 1%, where it stayed for all of 2020. Now, enter 2021, and the 10-year yield started rising again. And it hasn't fallen back below 1% since January 5th. It actually hit a high of 1.74% on March 19th. Long-term rates, overall, 10-year, 30-year rates, have leveled off since then, despite all the recent strong economic data that, if you think about it, should be fueling more investor confidence. So what does it all mean? How does it impact you if you're investing for income? We'll talk about that in just a minute. But now it's time to get to another one of your questions. Andy from Vermont asks, Dave, what are your thoughts on Bitcoin as an investment? Well, gosh, Andy, we could spend a whole show talking about Bitcoin. And Bitcoin, obviously, the return on it over the last several years has been phenomenal, better than almost anything else. However, you have to remember that Bitcoin is a very speculative investment. Some call it the new gold. But it's really not, because a metal like gold has an industrial use, so it has some basic underlying demand. Whereas Bitcoin has no such basic underlying demand, unless at some point it's truly accepted as a currency. And up till now, it's really been too volatile for that. So if you want to use just a tiny bit of it, kind of sort of as a gold substitute, I've seen some studies that say it could create a hedge, but you have to be very, very careful. Not to mention the fact it's really not all that simple to buy and sell. It's not like you can buy it in your brokerage account. So Andy, thanks so much for your question. And remember to send me your retirement questions by emailing me here at askdave@theretirementincomeStore.com.
So Dave, we've been on this roller coaster with interest rates. At the peak of the pandemic, rates crashed to 0.5%, but since they've been going up. And I think rates are going up because it signals confidence coming back to the economy. What do you think?
Well, and that's exactly why the market seems to be handling it well. You remember when the Fed was raising rates artificially back in 2018, and then the stock market had a pretty big pullback toward the end of 2018. It didn't like it. So when rates are going up artificially, it's bad for the markets. When rates are going up naturally because the market perceives there to be future growth, then it's actually a good signal for the market. So great point as usual, Jeff. And after the break, we'll talk more about factors that affect the bond market other than just interest rates. And we'll get a chance to hear from income specialist Michael Stewart. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton, and it's great to have you here as we discuss how this recent market mania has affected income investors. So far, we looked at the stock market, the bond market, and how both actually reflect the broader economy. But now let's talk about what all this has meant if you're investing for income. And let's start with the inverse relationship between interest rates and bond values, which is one of the best known principles in investing. Because falling interest rates means bond values rise. Rising interest rates mean bond values fall. And that's true to some extent. However, if it were just that simple, then it would mean that if you're invested for income with bonds and bond-like instruments, your portfolio has been shrinking steadily since January when interest rates started rising. But for many, that hasn't happened. In fact, many income investors have done very well in 2021. And they've done well because interest rates aren't the only thing that affect bond values. Because another important factor that we've discussed before on the show is credit spread compression. It's a fancy term which basically defines the amount of extra interest an investor would require to go from a risk-free U.S. Treasury to a corporate bond of a certain grade. When interest rates rise due to investor confidence, credit spreads compress. And this actually creates a natural softener for income portfolios. So even though the yield on the 10-year Treasury went up by over 0.8% from January to March, the rate on certain double and triple B corporate bonds went up by much, much less. And for you, that means even though long-term rates have risen, your allocation might just have kept your income portfolio from dropping at all. But let's get more specific. If you were invested in a 10-year U.S. government bond, the value of your investment dropped by about 7% in the first quarter of 2021. If you were in a diversified portfolio of bonds and bond-like instruments, the question becomes, did you see your portfolio shrink by 7%? Well, depending upon your allocation, depending upon your strategy, your portfolio might have been down just a little bit, or maybe not at all. In fact, portfolios of many income investors are actually up year-to-date 2021. And the softening effect of credit spread compression is only one reason. We'll talk about some others coming up in just a bit. But first, let's get to another one of your questions. John from Florida asks, Dave, I've read a lot of speculation about different bubbles, a tech bubble, a bond bubble. Do you think we're in a bubble today? That's a great question. I've heard all different opinions from very, very smart people. Generally speaking, though, I would say no. And the reason is because there's still a lot of caution out there. Usually bubbles occur when caution goes to the wayside and everyone's in. But right now, there's still a lot of cash on the sidelines waiting to get invested, which is usually a sign that we're not in any type of bubble. If I were to say there's a bubble anywhere, I would say the possible bubble we might have is a credit bubble. But for it to have us actually have a credit bubble, we'd have to have interest rates spike. I mean, rise significantly, like triple or quadruple over current levels, because then individuals and even companies to a certain degree wouldn't be able to carry the interest payments on that debt. And I don't foresee that happening. So in simple answer, my best guess, probably not. And don't forget to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com.
So Dave, it's been a very interesting 18 months as we've gone through COVID to watch what's happened with rates and what the exact effect on credit spread compression has been. And so what we have found is people that have held onto their bonds, of course, the prices have gone up, which drives the yields on bonds lower today, causing that compression. But people that have held their bonds, values have gone up and they've been able to weather this small increase in rates since the beginning of the year. How do you see it?
Yeah, and not only that, but also, there's other bond-like instruments that can create, that can do well in the rising interest rate environment. So if somebody has maybe a little bit in something called BDCs, maybe a little bit in something called real estate investment trusts, that can always help too.
No, there's no doubt about that. Investing for income in the stock market can also minimize risk in a rising rate environment, but we're really not threatened by a substantial increase in rates by the Fed. This rise happened because we hit a low point. Rates dropped to 0.5% on the 10-year because there was no confidence in the economy. And then once the Fed had the open checkbook mentality, what happened? Rates started to go up as the economy gained more traction.
Sure. Yeah, and the rates went up, the economy gained more traction. But again, it's not because it's Federal Reserve manipulated, it's because it's authentic. We're seeing better GDP numbers, we're seeing some inflationary pressures, and because of the good news, economic news coming out, it's an organic increase in interest rates, and that's why it's still been good for pretty much every market so far. Now, Jeff, it's time now to bring in another one of your favorite guests, and that's Michael Stewart. Mike is the founder of Crystal Lake Tax and Financial. He's also co-author of the book, Purpose-Based Investing. Michael, thanks for being back with us here on the Income Generation.
Appreciate you guys having me.
So Mike, it's great to see you.
Jeff.
Thank you. Well, listen, I'm curious. If we look at the last 30 days of activity in the markets, tell us about some of the feedback you're getting that's instinctual from your clients and customers and how they view the market at this particular time. What are they telling you about how they feel about the markets?
Yeah, realistically, they are kind of on edge. If you go back a year ago, we had kind of in 3 weeks that 30% drop back in March 2020 as all this coronavirus thing was rolling out. And then we've had a great recovery since. But they also realize that a lot of this recovery, which is based on the government kind of propping everything up, kind of borrowing trillions and trillions of dollars. So on one side, they're a little bit optimistic and they kind of want to hang on, just thinking that, as the economy reopens second half, then maybe things will improve. But they also are a little bit more realistic and they worry that it might be priced in a little bit as well.
Sure. And so, what I've seen, Michael, is that there's a flair for people being concerned about the political realm and the effects on what can happen with the economy, too. So there's a trifecta of sorts in terms of what people are concerned about. But how can the income model help our clients overcome their uncertainty at this time?
Yeah, I think this past 12 to 15 months has been a great example of why the income model makes sense for a lot of individuals that are either close to retirement or in retirement. If you take 2020 as an example, you kind of had the best of worlds and the worst of worlds. And one of the reasons the income model made sense for a lot of those nearing and in retirement is that although that there was volatility, whether it's in the stock market, if you're in dividend paying stocks, or even just various fixed income bonds, bond-like instruments, what didn't change throughout the year with all the uncertainty and, waiting for shoes to drop and things was the fact that the interest and dividends continue to be paid. So for those that either wanted organic growth or just wanted to have a little bit more consistency of income in their portfolio to either reinvest or take, they were able to continue to get that throughout the year, independent of what market conditions provided.
And even more so than that, Michael, appreciation has been crazy, even in income accounts, with the rise of the markets the last 12 months. Are you seeing that yourself?
Yeah, we're seeing that as well. In our income models, we tell clients, take away the equity portion of it. Typically 4 to 5%, consistent returns is kind of where our sweet spot is. But we've seen a lot of the principal on a lot of these kind of bond-like instruments, these bond proxies, continuing to go where they're actually getting double-digit returns on their fixed income as far as total return goes.
Which is great for fixed income, especially in today's environment. So let's say we get a dip in the stock market between now and the end of the year. Your best guess, is that a buying opportunity or is maybe that a chance to de-risk?
Yeah, so we're cautiously optimistic kind of going forward. So, as the economy is going to reopen in the second half, people begin to travel, get a little bit more comfortable going up. There's a lot of pent-up demand. We think that that's very bullish for the economy's second half. But when you look at kind of that hockey stick recovery that we've had, you have to also got to be some concern that, is it built in? So you got to be kind of proceed with caution. So sure. I would think that, if maybe you miss this rally, then, it might be an opportunity to, if you've been sitting in cash or a little too conservative over the past 12 months, that might be a buying opportunity just to get your allocations back right and maybe some good blue chip dividend paying stocks or so to get income and potential capital appreciation. But if you kind of, missed the boat, everything sold off a year ago and, you've luckily through hope alone, kind of held on with both hands. And then now we start getting a little weakness. It might be the time to de-risk a little bit and get back to the percentage of risk that you really need to be, not where you are right now.
So it depends upon your starting point, which makes some sense. Michael Stewart, thanks so much for being back with us today and being such a good friend of the income generation.
Thanks for having me.
Coming up, we're going to have income specialist Matthew Johnson on board with us, and we're going to talk more about how a diversified portfolio with the right income strategy can help further limit the impact of rising interest rates. We'll be back right after the break.
Did you know women typically receive less Social Security money when we retire? On average, we earn less money than our male coworkers. We're also more likely to take a break from the workforce to raise children. Women generally receive at least 15% less in Social Security benefits. Have you done all you can to maximize your Social Security? Visit womeninretirementnow.com and download our free Women's Guide to Retirement Planning. Learn more about the challenges women face in today's world, as well as unique solutions to achieve your retirement goals.
Welcome back to the Income Generation. I'm David Scranton, and today we're talking about Market Mania 2021 and what it means for you as an income investor. And so far, we've talked all about the activity in the bond market, the activity in the stock market, but we also dispelled the myth that rising interest rates spell doom for income investors. Now, let's dispel that myth even further. You see, another common misconception about investing for income is that it means shunning the stock market. And yes, it can mean that. And some income investors do choose to pull out of the stock market altogether. However, many others with a higher risk tolerance actually choose to lower the risk, but stay in the stock market. And investing for income actually allows you to do that. For example, certain tools like the ones I mentioned just a moment ago, business development companies, real estate investment trusts, have bond-like components. And while these strategies carry more risk on a standalone basis, when you pepper these instruments throughout an income portfolio, they can actually lower your risk. How? By offsetting the effects of rising interest rates. And that's exactly what happened for many income investors in the first quarter of 2021. Why? Because the REITs and the BDCs have performed very well since the start of the year. Now, if you have even a higher risk tolerance and you want to stay in the market with a general diversified common stock strategy, then an income specialist should be able to show you a more practical way to do that after the age of 50. See, the trick is to switch from investing for capital appreciation in growth stocks to investing for income, to investing for dividends in value stocks. Now, sounds simple, right? But investing for dividend return in value stocks is actually much more difficult to do than investing for growth or investing for momentum. In fact, it takes a specialized knowledge of the markets and of the many dividend-generating options available. But making this shift after the age of 50 makes sense for a whole bunch of people. Why? Because that's when retirement income and asset preservation become top priorities. And ultimately, it can give you a stock market strategy that offers more upside potential with less downside risk. Here's the bottom line. While certain market conditions since the start of the year have created some challenges for income investors, other factors have actually helped minimize those challenges and have helped create new opportunities. Something we'll talk about more coming up in just a bit. But first, let's take one more question from you. Dale from Georgia says, I've been with my current advisor for a long time. Do I really need to change advisors to start investing for income? Well, Dale, obviously, I don't know your advisor specifically, so the answer might be yes, might be no, but I suspect it's going to be yes, and here's why. If you've been with this person for a long time, it means you're with them starting at a young age. So you're probably in more growth-based strategies. So my guess would be that's your advisor's specialty. And unfortunately, most advisors don't specialize in both growth and income. They specialize in one or the other. Much like offensive coordinators and defensive coordinators tend not to cross lines. They tend to come in on one side and stay on that side because that's how their mind is wired. But Dale, that shouldn't be a big deal because here's the reality. You outgrew your pediatrician at one stage in your life to get a primary care doctor. And I'm sure there'll be a point, God willing, that you live to a ripe old age where you might have to give up your primary care doctor and go to a gerontologist, somebody who specializes in working with older folks. So if you have to make a change, it doesn't mean that your current advisor did a bad job. It just means that perhaps you've gotten to a life stage where you've outgrown that advisor. And for the rest of you, don't forget to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com.
So Dave, I have found over the years, and more so than ever, investors really don't understand the difference between growth stocks and dividend stocks. As a matter of fact, Dave, what compounds that problem is the fact that every financial advisor is out there promoting growth, and they don't even understand the difference between growth stocks and dividend stocks and how to create income. Tell me about some stories that you want to share with the audience in that regard.
Well, it's interesting because I think the biggest thing without overcomplicating it, is that 90% of investors, when they talk about growth, they mean capital appreciation. They mean buying a stock at one price and having it go up to a higher price. Whereas when you and I, Jeff, talk about growth, we're talking about growth or momentum investing versus value investing. So I think for many, the problem really resides in the basic understanding of that definition.
There's no doubt that it does, but it doesn't change the fact that investors all have tunnel vision, Dave. They either are in the market and they are accepting the potential for risk, even at these all-time stock market peaks, or they're completely in cash today because they're petrified of what's going to happen. There's no, or what could happen. There is no middle ground from their perspective because the culture financially has never shown them any other opportunities. That's what we do every week on the Income Generation, is teach people about income and how to maximize that opportunity as an investing platform.
You're right. I mean, so many advisors today got in the business in the 80s and 90s, the best stock market in U.S. history. And as a result, they became growth-based advisors. And maybe those that came in after that, after the year 2000, are those that are a little gun shy that you talked about, that might be sitting in cash. And the same is true for investors, depending upon when you got started, whether you got started in the 80s and 90s or you got started after the year 2000. And I think that's a great segue to introduce our final guest, and that's our good friend, Matthew Johnson, president of Johnson Wealth and Income Management in the great state of Iowa. Matthew, it's great to have you back here with us on the Income Generation.
Thanks for having me, guys. It's always a pleasure.
So Matthew, you know, we always have fun every time we get together, but I got to tell you, in the NBA, they fear the beard, as in James Harden. But today, should people be fearing the markets? Tell us what your clients are feeling.
I think that there's a great deal of skepticism right now. It's like very surreal. The market continues to go up, and they want to be a part of that growth, right? It looks really attractive. There seems to be a lot of optimism. And yet at the same time, there's always kind of that nagging fear in the back of their minds that it's not real and it's not going to continue to go up. It's going to have that revert where it goes back the other direction. And so there's a lot of fear. I think a lot of skepticism. People are ready to pull the trigger and get out at any time.
So they are fearing the market then at this point, because a lot of them are saying, you know what, the market's at an all-time high. We're printing up all of this money, massive money printing, more money today, MMT. It's crazy what's happening. And I think it's scaring consumers. And so I'm not surprised to hear you say that. So give us your forecast on what you think the market's going to be like the next 6 to 12 months. Or when should customers really consider de-risking is the real question, MJ.
Well, at least in the time being, I think things are going to continue to stay fairly moderate as far as, you know, I think maybe we may be over the hump as far as the exponential growth right now. It'll continue to grow maybe a little bit. I don't see this current administration making too many waves, but I think towards the end of the year, that's when we really have to really start reassessing the risks that we're taking on our money. We've got all sorts of proposals that are on the table, things that in some way, shape, or form can very much affect the stock market. You know, whether it's a bunch of real estate being sold because people want to realize the capital gain in 2021 versus 22. There's going to be a lot of factors that could create volatility towards the end of the year and going into 2022. So I think keeping your ear to the rail and really paying attention to how much risk you're taking on is going to be super important.
And the good news is, even if your clients have gone from growth to income, but stayed in the stock market, even if they get caught in a downdraft, at least they're still satisfying their income needs. Isn't that correct?
Absolutely. This goes back to the old, way of making certain that you're well diversified. It's not about having 14 different mutual funds. It's about having different asset classes, right? So having cash, having fixed income, having money in growth. If you're going to be in growth, I'm a big believer in value stock. I'm a big believer in dividend payers. I think we have to make certain we're continuing to focus on what's the outcome for the stage of life that you're in. And if you're in retirement or you're close to retirement, then you owe it to yourself to really start reassessing and understanding that income is going to be one of the biggest components of your life in retirement.
Yep. Said perfectly from someone who has a lot of farmers as clients, and they know that it's not about the value of the land, it's about how much you can sell the crops for. So Matthew, it's been great having you on board as usual. Thanks so much.
Thanks so much.
And a big thank you to you for joining us here on the show. And a special thanks to Jeff Small, Mike Stewart also, and John Najarian. We've had a great time today. If you're close to or you're in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.